Hello, I'm Wade McElwain, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. Stocks are off to a blistering start in 2021. The Dow, S&P 500, NASDAQ all hit record highs in the first week. In Asia, China's CSI 300 stock index surged to its highest level ever. Numerous growth stocks also reached new highs. Tesla, one of the leaders of the pack, accelerated through $800 to command a market valuation of $834 billion. Perhaps reaching $1 trillion will not be too difficult this year at the current pace. All this high drama is hyper exciting for the bulls. Away from the limelight, however, some notable but no less important market trends are developing quietly, such as Treasury bonds. Did you know that the 10-year U.S. bond yield just broke above the 1% level last week? So what, the bulls may reply, but this is the first time the yield closed above the key 1% since March 2020. Technically, this could be a significant breakout. During the last Fed meeting in December, the central bank committed to buy $120 billion worth of bonds every month. So why are Treasury prices falling even though the U.S. central bank is buying billions of it? Furthermore, aren't government bonds supposed to go up when the political turmoil escalates, like the riots in Washington, D.C. last week? These are intriguing questions. Perhaps the market is worried about inflation more than ever. Perhaps the market is anticipating a higher stimulus bill following the election victories by the Democrats. Or perhaps the credit market is expecting a faster recovery after the approval of multiple COVID vaccines. Whatever the reason, the breach of 1% in the 10-year could be a trigger for a larger sell-off. Look at the chart of iShares Treasury bonds with the ticker TLT, an ETF getting an increasing amount of attention from institutional investors according to Trackstar IQ, our proprietary search tracking tool. Its chart is distinctively top-heavy after last week's decline below 155 and is a textbook example of a bearish breakout. Hence, there is a case for a tactical short here, betting on further bond price weaknesses. But the bond bulls will say this is unlikely to happen as the Fed is in control of the yield curve. When the 10-year interest rate rises quickly, resulting in a bond market sell-off, the central bank will swoop in and support that sector. This means that the downside opportunity may be limited for shorting bonds. That's true. Never bet against the Fed, as they say. However, just imagine, what might happen if the stock market continues its record bull run? Investors with a portfolio full of bonds will realize that they're overweighting the wrong assets. The fear of missing out means capital may withdraw from the bond market and join the party in stocks. The higher the stock prices, the greater this fear. The faster stock prices move up, the quicker the rotation. Over the past year, Trackstar IQ has shown high-growth U.S. equity ETFs topping the rankings amongst institutional investors, and nothing has changed in recent weeks. Already, some veterans are speaking out about the bull market entering into a mania phase. Jeremy Grantham of GMO wrote recently that the long bull market since 2009 has finally matured into a full-fledged epic bubble. We all know that during the latter phase of a bubble, interest rates go up as the demand for money increases. Perhaps the bond market is starting to anticipate this possibility. Moreover, even a central bank as powerful as the Fed can't control inflation figures. If we look through the commodity markets, oil is above $50 a barrel, copper is at a 5-year high, soybean at a 7-year high, rhodium at an all-time highs, etc. Eventually, all these higher commodity prices will be reflected in future inflation figures. Think about the impact of a falling US dollar too. From its March peak, the dollar index has dropped by more than 10%. This drop is undoubtedly caused by the Fed's massive easing programs. As long as the Fed is continuing the current QE, the US dollar is likely to maintain its bearish trend. A falling dollar means US import costs will increase, thus raising prices for consumers. In summary, there is a tactical case for shorting medium to long maturity US Treasuries following last week's downside breakout. But bear in mind that the central bank may come in to support the market should prices fall further, which might lead to a surge in equity inflows. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, Make sure you do your own due diligence before making any investment decisions.